This is the Asia Trade. I'm Shery in Tokyo.
I'm Avril Huang at the Singapore Space Summit. Your top stories this hour. Asian markets set to open in the shadow of record crashes in gold and silver, amplified by the biggest dollar rally since May. Oil in focus as Iran's top leader warns of a regional war if President Trump orders an attack. Also ahead, money managers including BlackRock and PIMCO shoring up their portfolios against a fresh bout of inflation if Fed Chair nominee Kevin Warsh backs deeper rate cuts. And the Modi government unveils a cautious budget focused on protecting India's economy from Trump tariffs.
We'll watch for market gyrations given the big moves that we saw in the last couple of sessions. Take a look at how U.S. futures are opening at the moment. Already, we had seen the downside pressure led by tech stocks, and we've now just heard from Nvidia's Jensen Huang saying that the company's proposed $100 billion of investments in OpenAI are not necessarily a commitment. So we'll be watching those tech stocks across the Asia session as well. We had already seen a lot of volatility with the dollar spiking on the news of President Trump's nominee for Fed Chair Kevin Warsh potentially being less dovish than the markets had expected. That spike, the biggest rally in the U.S. dollar since May, really leading to other fallout as well. The commodity sell-off, especially in precious metals, gold and silver. When it comes to gold, we're talking about the biggest sell-off that we haven't seen in about 4 decades or so since the 1980s. When it comes to silver, we're talking about a 40% plunge in less than 20 hours. So we'll continue to watch for any of those related stocks in the precious metal space, in the broader metal space as well, given that we have seen a lot of gyrations last week with copper prices as well. But take a look at how we're setting up for the Asian markets opens, because we, of course, have the rise of the U.S. dollar, pressure perhaps for the Japanese yen, and this coming at a time when Prime Minister Takaichi has complicated her own path with her currency, because she seemed to signal that perhaps she was comfortable with the weakness of the Japanese yen. She canceled a TV appearance that was expected for this weekend, so we didn't really get any more clarity on what she meant by a weekend being a huge opportunity for those exporters in Japan. So we're seeing the Nikkei at the moment pointing higher to 0.6%, and we'll continue to watch the metal space. Miners, of course, a big market is Australia. We're seeing the staggered open there, a dive of 0.6% early in the session, and you can see the offshore yuan holding steady after we had factory data deteriorating more than expected. The latest figures out of China, we are expecting the private gauge as well. So plenty to discuss with MLife strategist Mark Cranfield, who joins us now from Singapore. I don't know where you want to start, Mark, because there's so much news over the last couple of days, over the weekend as well. What is key to you in what will be the catalyst for the Asian session?
It's pretty hard to look beyond the currency, metals, the precious metals fallout from Friday. I'm sure we haven't heard the last from that. You can't have such enormous swings in gold and silver, which already started to affect currencies, without more of a fallout, particularly as it came right at the end of the month as well. So although retail investors are thought to be some of the biggest participants, particularly those in China, investors will also be looking to see if there's any major funds or other trading houses who got involved in this. There will certainly be some winners, but we're certainly going to be on the lookout to see who were the big losers, especially when the rally crumbled so abruptly on Thursday and Friday. So there's bound to be a lot more fallout, spill over into various markets. Just look at the Canadian stock market. It dropped 3% on Friday in what is usually a very tame, quiet market. So you can see the repercussions are going widespread. There will certainly be more. Australian dollar is already under a little bit of pressure again this morning. There was a big swing in that as well. So the fallout from gold and silver will probably continue for a few days yet, and we'll be watching all the currency plays in relation to that.
Mark, you've flagged this not so long ago, the risk from hot money going into these crowded trades, and then now it's come out on the other side. Among these crowded trades, which do you think will be the most vulnerable?
Well, certainly the precious metals in itself is a big risk, but if you see how it was driving short dollar positions, that was certainly, there's a build up there. You look at the speed of the Australian dollar rise over the past couple of weeks has been really phenomenal. And now you've got Prime Minister Takaichi clouding the issue on the yen. So it's just over a week ago that we had the price support from the US Federal Reserve. They intervened verbally into financial markets. It helped send dollar yen down quite dramatically just over a week ago and into the beginning of last week. And now Takaichi has really confused the whole situation by suggesting that she actually prefers a weaker currency. Now, that is probably targeted at her election bid, which is coming up this weekend. But from the investor's point of view, it really suggests there is no clarity and there's no uniformity on what they actually want for the Japanese currency. Scott Bessent has already stepped back, saying that he's not explicitly supporting the Japanese currency. And now you have the Japanese authorities themselves seemingly a little bit confused as to what they want with their own currency as well. So traders can see that. They can see there's a lot of gaps between the Bank of Japan, between the Ministry of Finance and where the US stand. They would exploit that. Dollar yen's already higher today, and there is clearly a risk here that it reverses the whole move that we saw. Dollar yen was about 159 when the US authorities started talking about the currency, came all the way down to the 152 area. There's a risk that we go all the way back up before the elections this weekend. So the yen is really right in focus here as probably the currency most exposed to the markets in the next couple of days.
Yeah, I know. I had ordinary Japanese friends here waiting for her TV appearance to get some sort of clarity on what she meant about the Japanese yen, and it seems that she canceled at the last minute. But right now, not just Japan when it comes to inflation concerns and where price pressures are going, but just overall, we have seen the gyrations, not only in JGBs, but treasuries as well. Treasuries, in fact, losing a little bit of momentum, but there are now rising inflation concerns that might not be necessarily the market call, but we are hearing from the likes of BlackRock, PIMCO as well, that inflation swaps are continuing to rise. What are the dynamics right now at play?
This is going to be a tricky one for investors for several months ahead. So the proposal that Kevin Warsh is going to be the chairman of the Federal Reserve really has helped to spark this whole inflation debate in the bond market. So Warsh has previously said that he sees AI as bringing down costs for American companies, but at the same time, he wants to reduce the balance sheet of the Federal Reserve. Well, the two don't look as though they can work at the same time, particularly when people are already very cautious about the inflation data in the United States. Because of the cutbacks to the government last year, the quality of inflation data is no longer seen as being particularly good by people who trade in the bond market in America. So the default action for everybody here is to steepen the US Treasury curve. People want more compensation for the longest tenors in the bond market because they fear that the inflation will be more to the upside than probably even is being reported in the United States. So the bond vigilantes are not going to give Warsh much time. If he does become chairman of the Federal Reserve, they're going to be on to him very quickly. The bond market will be telling him, we want clear messaging, we want you to be disciplined on inflation. If you're not, bond yields are going to go up dramatically, particularly in the 30-year sector. We're getting close again to the 5% area. This time we may sail through because people will be, what they call the term premium, will need to get thicker to compensate for the risk that there's a discrepancy between what the Federal Reserve wants and what the data is telling them. And bond markets don't like it when there's a discrepancy of that kind.
Unless Strategies, Mark Cranfield there with a look at what could move markets today as we continue to get the latest headlines with silver prices continuing to drop, a record plunge right now of almost 6%. Of course, we saw some big moves in the Indian markets as well, given that the government has delivered a budget that sharpens Prime Minister Modi's strategy of shielding the economy from U.S. tariffs while maintaining fiscal restraint.
Fiscal deficit kam karne.
The budget focuses on reducing the fiscal deficit and inflation control. The budget also harmonizes high capital expenditure and high growth. This budget reinforces India's global role.
Let's bring in Bloomberg's Asia Pacific reporter Swati Pandey for more on this. So Swati, what were the key takeaways from the budget?
This budget was really highly anticipated, especially after big spending cuts that were announced last year and the simplification of Byzantine labor laws. However, the government steered clear of making any big ticket spending in this one. There were some announcements on infrastructure spending. There were some announcements to help India's strategic minerals industry, to boost semiconductor manufacturing. When Finance Minister Nirmala Sitharaman started her speech, she said it was going to be a youth-oriented budget. But there are still question marks around whether the budget can really prop up economic growth and boost employment, especially for young people in India.
So amid those questions, where does India stand on ways in which to buffer the Indian economy from global risk, and then balancing that against the backdrop of advancing some of these structural reforms, including manufacturing for the country?
Yes, so India's economy is really reeling from US tariffs, which is 50%. And the government has announced plans, including in this budget. There have been proposals to boost small and medium businesses. There are proposals for textiles and leather industries, which are very highly impacted by these tariffs. So that is the primary plan, right, where they are trying to provide SOPs to the industries that are very highly affected. Exporters, there is a bit of this self-reliance thing as well, where the government wants India to have its own semiconductor manufacturing, where they have relaxed some tax on import of equipment for processing of rare earth magnets. So they are kind of like trying to do those type of stuff, which is their primary plan. But then there is a secondary plan where they are trying to build trade ties and free trade agreements with other countries. So last week there was the EU, the trade agreement with the European Union. And last year, India did a trade agreement with the UK and with New Zealand. And there are going to be many more that will come likely in the coming months.
Bloomberg's Asia Pacific economy reporter Swati Pandey there. And we continue to hear more news about AI spending and the broader tech space right now, with the likes of Oracle expecting to raise $45 to $50 billion in gross cash proceeds during the 2026 calendar year, using a combination of debt and equity financing. On the equity side, Oracle plans to raise approximately half of its 2026 funding through a combination of equity-linked and common equity issuances. We have seen massive spending coming from Oracle in order to fund artificial intelligence expansion. And we have seen its shares falling more than 50% from last year's all-time high, given concerns about the payoff. We're also watching the commodity space, especially with oil prices, as we continue to watch the latest on tensions with Iran. The supreme leader there, Ayatollah Ali Khamenei, has warned of a regional war as tensions continue to mount over potential U.S. strikes on Tehran. But President Trump says he's still hoping to reach a deal.
Why wouldn't he say that? Of course he can say that, but we have the biggest, most powerful ships in the world over there, very close. Couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Bloomberg's editor Tony Chushkai is following the latest developments. And Tony, it seems the warnings from Iran are pretty harsh, but President Trump seems to be pretty confident that a deal might be able to be struck here.
Yes, and this has just been a steady war of words with different sort of nuances and tone, shifts of tone in recent days. And you heard Trump sort of putting this notion of a deal with Iran, which presumably would be about basically somehow reviving this idea of stopping its nuclear program in his latest statements. And it's what's changed in recent days is that what Trump called at one point called an armada, in other words, a U.S. military deployment, naval deployment in the region is apparently has been a gathering force and being put into position. Trump said today it's a matter of days. I think it's a sort of a general ramping up of this pressure campaign with diplomacy going on at the same time. In various ways, with Iran enlisting some of its potential allies, maybe, or brokers in the Middle East, broader Middle East, and some Israeli military officials in Washington over the weekend. So the real speculation or question is, will the U.S. strike, and when and how exactly would that happen?
If the U.S. does indeed strike, what are the risks for this being a regional conflict?
Well, Iranians have said as much, and the U.S. knows that very well. I mean, there are U.S. forces in the region, including in Iraq, which neighbors Iran, and they've been in danger before from Iran and its proxies, or targeted, we should say. So, on the other hand, Iran has seen that the U.S. will not hesitate to strike, and Israel will not hesitate to strike it. As happened last year on these nuclear facilities. Now, one of the sort of open questions here is that Trump, if you recall, said at the time that the U.S.-Israeli strikes had obliterated, or U.S. strikes really, had obliterated Iran's nuclear program. And now that there's questions about how far that really went. And so now we're back to talking about a deal to limit Iran's nuclear program so that it never produces nuclear weapons. And Iran's position, of course, has always been that, well, we are not doing that anyway.
Right. Bloomberg editor Tony Chushka there with the latest on tensions on Iran. Great to have you with us as we continue to watch the price of oil right now under pressure, as OPEC Plus has also ratified plans to keep production steady in March. We have more ahead. This is Bloomberg.
You're watching the Asia Trade, and here's a look at the key economic events to watch this week. Australia's central bank faces the uncomfortable prospect of going against the global grain tomorrow and switching back to raising interest rates to fight resurgent inflation. Economists expect the Reserve Bank will increase its cash rate on Tuesday by 0.25 percentage points to 3.85%. Meanwhile, most economists expect India's central bank to hold its key rate on Friday, but a budget that sidelined infrastructure spending has Bloomberg Economics predicting a cut. Also on Friday, we'll get the U.S. January jobs reading with a pickup in hiring expected, and we have elections coming up on Sunday in Japan and Thailand. Shery?
We're also watching for China's PMI private gauge today after we saw factory activity unexpectedly contracting for the official numbers that we got over the weekend. Joining us now is Wang, Chief Asia Pacific Economist at Vanguard Group. Qian, great to have you with us. I mean, we are getting some conflicting PMI numbers, especially the weakness that we're seeing in China as compared to, say, Northeast Asia. We got export numbers out of Korea over the weekend as well, showing incredible strength.
Good morning. Thanks for having me today. Certainly, I think the PMI surprised on the downside, but that kind of a little bit pullback was indeed somewhat expected. I think, one, it definitely reflects some seasonal factors. There's some payback to the strength in December. And also ahead of the Lunar New Year, you would expect factory to slow down or even pause their production. Migrant worker went back home. But after you exclude all that seasonal factors, I would say there is no doubt that the domestic demand is indeed pretty weak in China, not just in terms of the demand for goods, but also when you look at the service sector, right? You know, service PMI was also somewhat weaker than expected. I think what's going to be interesting to watch, especially when you are talking about regional PMI, is the private PMI, the reaching dog, which actually focus more on the export-oriented companies, right? So it will be interesting to see how that PMI reading performs.
Wang, is there going to be a bit of spillover effect to other economies in the region? I mean, we are waiting for a bunch of Asia PMIs that are due in the next hour, and this is coming at a time where economies are grappling with both dollar and gold volatility. Is that also a problem for central banks?
I think to a certain extent, I think for us, the Asia region, right? The January number the February number is always very difficult to read because of the volatility around the Lunar New Year time. But in general, when you look through the monthly volatilities, I would still say for this region, the exports actually should continue to hold up well. And this is the key factor that's going to hold up the Asian economic growth this year. And then when you look at the global demand, especially for tech, that actually has been pretty strong going into this year. Business confidence in U.S. and developing market countries, that actually has been pretty positive. So this is not something I will be, be bearish, right, about Asia's exports. On the other hand, I would say for Asia central banks, what they need to look for is not just export, but also the domestic demand, right? There's a number of economists in the region that we are seeing like a K-shaped economy. Exports was great, but domestic demand is pretty weak. So I think this is where central banks need to be very cautious about what they want to do.
So, Qian, too, the volatility that Avril alluded to also a lot to do with the nominee from President Trump of who the next Fed chair will be. Are there any implications about Kevin Warsh potentially becoming the next Fed head for Asia, given that he has been seen by the markets and economists as less dovish than other contenders?
Well, I think, indeed, I think Warsh is actually striking a good balance, right? In terms of, restoring some market confidence about Fed independence. On the other hand, he definitely aligned with President on some of the policy initiatives. Now, I think at this juncture, he's arguing for lower interest rate because of the higher productivity growth, right? Driven by deregulation, driven by AI, that is going to be deflationary. But on the other hand, when you have higher productivity growth, you also have higher neutral rate, right? Which reduce the need for a lower interest rate. So overall, we are pretty comfortable with our call for one rate cut this year. Yes, rate will be lower, but it's not going to be a lot lower. So to that extent, I would say for this region, we are not going to see that much lower rates either, especially when exports and growth is holding up well.
Qian, thank you so much for the perspective. Qian Wang, Chief Asia Pacific Economist at Vanguard Group. We do have more ahead on the Asia trade. This is Bloomberg. And we have breaking news at the moment. President Trump announcing the closure of the Kennedy Center for 2 years for renovations. He's now announcing on his Truth Social post that financing is completed and fully in place. They will cease the entertainment operations for about 2 years to begin construction of new entertainment complexes at a time, of course, when we have seen a little bit of controversy around this building, especially with the leadership and the co-founder being fired.
Kevin Warsh is the right person at the right time, and he's a very independent, data-driven person. The president believes that if you are data-driven and not partisan, he thinks the Fed has been partisan, that rates could be a lot lower, and I think that Warsh agrees with that, and I agree with that. Like, you might forget that Kevin and I are old friends. We have offices, or used to have offices, right next to each other at Stanford, and have talked about these things for a long, long time. I have high confidence that he'll go in there and he'll accomplish the right goals.
White House economic advisor Kevin Hassett, who at one point was also seen as a potential contender for the top job at the Fed. And with the news around Kevin Warsh, we have seen big moves in the FX space with a spike in the dollar that saw the best day since May. This, of course, after falling already to a 4-year low. We had also seen metals sell-off as well, given the strength of the greenback. We have been following commodities currencies like the Aussie dollar, which you can see there strengthening, and also a little bit of downside pressure on EM currencies given greenback strength. But suffice it to say that it's been an amazing year for EM assets. We have seen emerging market currencies also gaining ground in the previous month, and stocks also gaining about 9% or so in the month of January. Japanese yen, a little bit of idiosyncratic news given the Prime Minister Takaichi seems to be a little bit more comfortable with a weaker Japanese currency. And you can see markets now pricing in Kevin Warsh becoming the next Fed chair and what the dollar has done, and that steepening of the Treasury yield curve as well. Joining us now is Dennis Lockhart to discuss all of this. He previously served as the Atlanta Fed president. Dennis, always really great to have you with us. And of course, you not only served as the Atlanta Fed president, you actually served together at the FOMC with Kevin Warsh, who back then, at that time, was seen as an inflation hawk. Where do you think he stands now?
Well, it's not so clear now. His history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates, as well as the balance sheet. And he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets, which is, of course, would be interpreted as tightening. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May. I think probably he will be data dependent, and with the committee will make the best decision he can.
Given that there are 12 voting members on that committee, how significant is the influence of the Fed chair, and what do you expect to be sort of the direction going forward in the next 12 months?
The Fed chair enjoys a great deal of deference from other members of the committee. And in my experience, when it's a close call, the chair's preference often prevails. Having said that, a new chair has to earn the respect of the committee. And so I think he's going to have a honeymoon period. And during that period, he'll be trying to conduct himself in such a way that reassures the committee that he's going to be independent. And we'll see how that plays out. I think Kevin Warsh will be navigating some tensions and some conflicting views on the committee. So it's not an easy road for him in the first few months.
On the data front, there's talk that we could see inflation creeping back up. Certainly from the likes of PIMCO, that seems to be their assessment. Is there a chance that we don't even see a cut this year?
Always a chance, particularly when you're looking forward early in the year. There's so many months ahead of us that it's very difficult to predict. My personal view is no cuts in the first half, but maybe a repeat in the second half of some cuts that look a little bit like the last 2 years. But that's just speculation at this point. It will depend on how the economy evolves. And we have both elements of the dual mandate, inflation and employment, showing a trend, but not a trend that could not be broken by new events. So it's very hard to predict, I think, at this stage. One more cut is a reasonable and plausible assumption, I think.
Among the potential market-moving bits of information that we've gotten in the past couple of days also is how Trump looks set to nominate someone else for the BLS chief position. I mean, what is your sense of how data integrity is shaping up at the institution? Trump is talking about how the BLS needs fixing. Is there something there at the BLS that needs fixing? Is that also your assessment?
Well, the U.S. data, we're the best measured economy in the world, in my opinion, but the data have suffered in recent years from collection problems. For example, people don't answer cell phone calls, and so the survey samples have been fewer, and other problems with the accuracy of the data and the reliability of the data. That said, the Bureau of Labor Statistics, for example, is a producer of the gold standard of government data, and the economists, particularly the Fed staff economists, rely heavily on that. So yes, there can be reforms, there can be improvements, methodological improvements, I think, but I'm not going to question the integrity of the data. I don't think anyone on the BLS staff is playing games with the data.
And Dennis, you've been actually concerned, not necessarily about the U.S. data or the strength of the economy, but potentially about some other risks coming globally that could become a significant financial event, such as the big gyrations and meltdown that we've seen here in Japan, in JGBs, and what's happening with the yen. Can you explain to us why this could be important eventually, even for the U.S. and the Fed?
Well, the financial markets are interconnected. What goes on in Japan affects the dollar and affects the U.S. Treasury market, at least potentially. We're in a period with very high government debt levels around the world. Japan is at an extreme, but the United States has also is heavily indebted at the federal level. So, you have to worry about some event in one part of the world triggering a bit of a cascading financial event, maybe not a crisis, but a financial event. And it's these imbalances that result from public finance, particularly, that worry me the most.
What are some of the other risks that maybe we are not appreciating enough when it comes to looking at the U.S. economy, you think?
We've got some imbalances in the U.S. economy. The consumer, for example, the U.S. consumer is continuing to consume because most people who want jobs have jobs. But we could conceivably see a weakening labor market, which would shut down some of the consumption. We also have, a very bifurcated picture of the affluent and the wealthy driving consumption, with the lower 50% not in a position to consume and struggling to get by month to month. These are not necessarily healthy, a healthy picture, even though the overall aggregate picture looks to be quite strong. So it's those imbalances within the numbers that I think could lead to a different scenario this year than is currently expected.
Dennis Lockhart, always great to get your perspective. Thank you very much for joining us. He's a former Atlanta Fed president with his views, of course, on the state of global monetary affairs at a time when we're also watching perhaps those imbalances in the commodity space as well. Right now, we're seeing gold and silver futures rebounding a little bit, but after an abrupt sell-off that actually sent gold to the biggest slide in 4 decades. We hadn't seen that since the 1980s. Silver also plunged at one point by $40 an ounce in less than 20 hours. We're seeing a little bit of a recovery there. Geopolitical tensions also weighing in the oil space. Brent, WTI at the moment under pressure. All of this, as we heard from President Trump, a little bit more optimism about a potential deal when it comes to Iran. But it's really been about the gyrations in the commodity space, especially last week with copper prices as well. A lot to do with of course, the huge amount of speculation that we've seen, especially on the Fed's trajectory and perhaps what's happening with the U.S. dollar as well. And all of these commodities, metals, so important for new technologies, especially space technologies, with the constellation of satellites that we have, new launches, costs coming down. All of this to be discussed, Avril, where you are at the Space Summit 2026.
Absolutely. That's why my backdrop is a little different today. We are at the Singapore Space Summit, and this is coming at a time where observers think this economy in space can grow to $1.8 trillion over the next 10 years or so. So certainly a lot of opportunity there. This is coming at a time where there's a lot of market talk on SpaceX's potential IPO this year. Maybe that is another tailwind for the industry to watch. What is key is also how the private sector, commercialization of the industry, that seems to be what is going to propel the sector. Not so much your government players that were traditionally the sort of anchor players in the traditional space race. So that's a key difference in the industry as we see today. So in a few minutes, we'll be speaking exclusively with Japanese satellite company Synspective. Stay tuned for conversations with Galaxy Space, Pixel Space, and Agnico Cosmos as well. We have more ahead on the Asia trade. This is Bloomberg.
We're less than 20 minutes away from the market opens in Japan. We continue to watch Nikkei futures after a session of losses already for Japanese stocks. We had seen some significant pressure on the Japanese yen as the U.S. dollar spiked at the best day since May. Given news about Kevin Warsh being nominated to become the next Fed chair, seen as somebody who would carry out less deep cuts in interest rates than potentially other contenders would have. We're also watching JGBs very closely. They gained ground. We had a strong 2-year auction that saw better demand than its 12-month average. But it's really about the movements in the Japanese yen, right? Because we had dollar strength, but then again, the yen lower early Monday after Prime Minister Takaichi's comments over the weekend that a weak currency can be a huge opportunity for Japanese export industries. Takaichi took to social media trying to clarify her comments, saying she only wants an economy that can withstand currency fluctuations. Let's get more with economy and government reporter Yoshiaki Nohara. Yoshiaki, so there is really confusion about what the administration is trying to do, right? I mean, we had seen this incredible weakness in the yen that government officials, that the BOJ were not happy with, but now Takaichi's comment seems to complicate everything, and the cancellation of her TV appearance just makes things difficult to understand.
Right, Shery, thanks for having me. What Prime Minister initially said, which was, mentioning the benefits of a weekend for exporters and also potentially working as a buffer against the higher oil tariffs. That's kind of unusual for the government to say because they always try to maintain the balanced approach. There are pros and cons about weak currency or strong currency. So in other words, she stepped a little bit further beyond the government's regular stance. But then, as you mentioned, she tried to clarify afterwards. So perhaps she realized that what she said could have implication in the market. And of course, we are seeing now the yen is weakening based on her comments. And I don't think that's been, pricing in the clarification parts yet.
I had a friend waiting for her appearance at a TV show in order to get some clarification from her, but that didn't happen because she canceled at the last minute. The point I'm trying to make is that Japanese households perhaps not too happy with how cheap the yen is because it makes everything more expensive as well when it comes to imports. So how might this play in the election?
Right. So that's a very good point. As you mentioned, I think that even regular people, will understand by now that the kind of pain that weak yen can bring to their daily lives via higher costs of imports, food and also higher energy costs. So, if Prime Minister was trying to be careful about that aspect, the negative aspect of a weak yen, I think she would be more careful. But I'm not sure if this point alone is going to be a decisive factor in this election because it's an election campaign season and people are hearing all sorts of things from all sorts of people. But of course, the weekend is a painful thing for the people, and they know that.
Yeah, Bloomberg economy and government reporter Yoshiaki Nohara, always good to have you with us as we watch the election here in Japan February 8th, the record shortest time when it comes to the dissolution of parliament and the election also happening. So very important for Japanese people to try to understand some of these issues, Avril.
Yeah, let's also zoom in at this event, the Singapore Space Summit, on the Japanese space industry. We have a major player in our midst. Synspective is a Tokyo-based space tech company that develops high-frequency satellites for disaster management, urban planning, environmental monitoring. Joining me now is founder and CEO Motoyuki Arai. Moto, great to have you with us.
Good to see you.
So our colleagues have just been talking about the lead up to the election this weekend.
Yes.
What have you been seeing in terms of Takaichi-san's focus on defense spending? Has that meant more interest in the space industry?
So recently, the Japanese government identified 17 important, focus domain to be promoted as a core industry for next 10 years or like that. So as a national plan, and of course, the space industry is counted one of that. And I think it's very good, synergy with the robotics, the AI, and quantum-relevant technologies. So yeah, that's why I think the current government.
All useful ingredients for the space industry, I guess, these sectors that you're highlighting. Talk to us about how big you see the satellite imaging industry actually getting, and how much is Japan a player in it at the moment?
I think, so when I established this company 8 years ago, it's actually there are not so many companies, including the established one and the startup, maybe less than 20 or like that, just tried making the new market with the out-of-observation data. But now I think over, including the analytics company, over, I think 50 or 60, maybe hundreds more companies try to commercialize the out-of-observation data. And I think current market is strongly led by the demand from the national security. So I think the many company focus on this, national security and connected space industry.
So what is the issue going forward looking like? I mean, with all these satellites going up, some say it needs to be sorted as critical infrastructure. Is there enough coordination among governments, especially when this is such a sovereign issue?
Yes, so far, before the, the current geopolitical situation, the out-of-observation company tried to looking for the, find out the very good market to, build up the cost-of constellation. Yep. But recently, as I mentioned, the national security demand leads and, bring the huge investment in this market finally. So, it means we have to take care about the sovereignty, closed system, local system with the very higher security and freedom to operate the satellite constellation.
How are you thinking about your North America expansion plans against this backdrop then?
Yeah, I think historically the Japan and the US have a very good relationship in both of defense intelligence and also economy. So currently the geopolitical situation is very fluctuated and it's very difficult to guess. But in terms of the mid-term or long-term, we have to invest in the biggest market, North America. So I think, now, as I mentioned, the friendship between the US and the Japanese government and the commercial layer as well. So we try to leverage this relationship, for making the new market for next 10 years or like that.
So what is the revenue growth you're expecting in the next 10 years then for Synspective?
Actually, it's very difficult to guess, but I think 10 times or more than 50 times like that can be expected, I think. Yes,
Right.
it just started this
And
month.
this is coming at a time when some people think that this space economy can grow to 1.8 trillion over the next 10 years. So certainly a lot of opportunity there.
Yes, especially north of the vision market. Yes.
Yeah, certainly. Thank you so much for sharing your plans for the business with us, Moto. Really great to have you with us. Motoyuki Arai is founder and CEO at Synspective. We have more ahead on the Asia trade. This is Bloomberg.
We're getting the summary of opinions from the January policy meeting by the Bank of Japan. One member saying that Japan's real rate is significantly low and the financial conditions remain accommodative. One BOJ board member also saying that they will raise the rate if the outlook is realized and that they need to adjust easing in a timely manner. Remember, the January meeting is when the BOJ left the rate unchanged at 0.75% after actually hiking in December. We have already seen Tokyo's inflation numbers come out last week showing that it cooled more than expected, but at the same time, consumer spending weaker than expected. So sort of perhaps backing the BOJ's gradual approach to raising rates. A BOJ member in that meeting saying that they need to, that what they need is rising to conduct policy at the right timing, that it's necessary to conduct policy at the right timing. You can see the Japanese yen continuing to be under pressure right there. On other idiosyncratic news, including Prime Minister Takaichi seeming to sort of back a weaker yen in her comments last week. We'll be watching some of those financial companies in Japan's trading session because, of course, with the rate changes by the BOJ, they have seen a significant boon. But at the same time, Nomura, for example, under pressure, reporting an almost 10% slide in profit in the last quarter, missing analyst estimates, and the result being blamed on losses in Europe, as well as a one-time hit tied to a major acquisition. Also, SMFG's profit, though, topped estimates. And that was a lift from higher interest rates here in Japan. Net income at this second biggest lender in the country jumping 12%. But plenty of more things to watch during the trading session in Asia, especially those metals-related stocks, because we saw those big fluctuations with the incredible crash that we saw in gold prices, in silver prices last week. After already gold had touched a record high of $5,500, you're seeing the downside pressure continuing, and Brent crude also down after we heard some more positive and optimistic comments coming from President Trump on a deal with Iran. The market opens are next. This is the Asia Trade. We're counting down to Asia's major market opens and bracing for potential gyrations in the Asia session today. After we saw that huge crash when it came to precious metals, gold seeing its worst day in 4 decades or so, Avril. And of course, the spike in the U.S. dollar, also a big trigger there, given that we finally got the nomination for Fed chair from President Trump.
Yeah, markets certainly reassessing their expectations of what the Fed's trajectory is going to look like for the rest of the year amid this uncertainty. What are Kevin Warsh's policies actually going to look like? Is he indeed going to sound a bit less hawkish than previously anticipated, Shery?
Yeah, that was his reputation when he was Fed governor. But then at the same time, we saw him align more with President Trump in recent years. So we will be watching, of course, all of the currencies on the other side of the dollar trade, especially Japanese yen, that's seeing significant pressure with that 155 level at the moment. But on top of course, the U.S. dollar strength that we're seeing on the other side, we have heard from Prime Minister Takaichi saying that a weak yen can be a huge opportunity for export industries. She's tried to sort of pull back some of her comments comments, but at the same time, we saw that she canceled the TV appearance over the weekend. So we are still waiting for more clarity on how tolerant this government will be when it comes to a weaker Japanese currency. In the meantime, you're seeing upside for the Nikkei of 0.4%. Perhaps some of those exporters seeing some gains with the weakness of the Japanese yen. When it comes to JGBs, we had a rather solid 2-year auction last week that we were digesting. Right now, the 10-year yield holding at that 228 level. And we continue to watch some of that commentary coming from the summary of opinions from their January policy meeting from the BOJ when they actually didn't move and they kept the rate at 0.75%. One BOJ member saying that it's appropriate to raise rates every few months. Take a look at how the Korean market is also coming online, because over the weekend, we had Korea's exports growing and extending those gains that we saw in January. We're talking about a 34% gain year on year. But what was interesting was the semiconductor side of things, because when it came to semiconductors, we're talking about 103% growth. So you can just tell the strength in that tech market that we continue to see, given, of course, the ongoing AI demand. Although we will continue to watch some of those tech names, because we have also heard from Nvidia's Jensen Huang saying that that huge commitment that they had potentially made in OpenAI was not necessarily a commitment, and that they would decide gradually as they go. So what implications will that have for tech stocks in the Asian session will be a big one to watch. As we're also watching those mining stocks, take a look at how Australia is trading, because gold, silver really got pummeled in the last few sessions, given that we saw that really abrupt downturn after gold actually surpassed $5,500 an ounce, which was a record high. But we have seen some moves by Chinese speculators in this space that have led to really a lot of volatility. You can see right there, U.S. futures also under pressure at the moment. But let's bring in Mark Matthews, head of Asia research at Julius Baer, to walk us through what's happening in the markets. Because, Mark, what a great time to have you with us as volatility continues to ramp up. There's so much news out there right now in every sector of the market. What is for you a key catalyst this week?
Well, I suppose to see what happens with the precious metals, because they were the big leaders of financial assets last year, gold in particular. And so this major pullback, I think the largest on record for silver on Friday, and the second largest for gold, and platinum and palladium. What will happen there? And if they continue to go down, would that have some kind of domino effect on other things that have gone up this year?
Other things, including tech stocks, right? I mean, it's interesting that the metal space has been so impacted by that potential commodity demand that we're seeing from the build out in AI, but also perhaps more speculation around what the Fed will do. And we have seen Chinese speculators, for example, just make that whole space very volatile. How big are the implications of Fed monetary policy here for the commodity space and the broader markets as well?
I don't know if that's so important. I think that the larger issue is the continued decline of the dollar, which I think would probably happen even if the trajectory for rate cuts in the Fed is not as aggressive as futures are pricing. And if the dollar does continue this debasement, which I think it will, a dollar index has often traded in the 80s before. It's still at 97. The U.S. government doesn't seem to mind a weaker dollar. Chinese President Xi Jinping gave a speech a couple of days ago where he called for a strong renminbi. To me, all of that suggests a world where, in fact, precious metals will continue to grind higher. So we view this big sell-off in them as a buying opportunity. I think the very leveraged players got flushed out on Friday. Volume was an all-time high in both gold and silver ETFs. And so long-winded answer, I think the primary thing is the changing dynamics in the currency markets.
To your point, Mark, even if we are a bit more positive on precious metals, though, given the dollar is expected to stay soft this year, the speed in which the currency complex actually moves along with precious metals and the size of that, I mean, the volatility involved, is that not a concern as much for you?
I don't think so, really. I think it will be a controlled change. And I say that principally because as much as I think the Chinese are going to allow the renminbi to appreciate, they want that appreciation to be very gradual. And that is the primary currency, I think, that emerging market currencies in general now take their cue from. So, of course, there could be volatility, but my sense is that it will be pretty low.
Okay. Talk to us also about some of the other areas of the market that you are a bit more positive on. I think you have a conviction call on Chinese stocks as well. To what extent will Xi Jinping talking about the strength of the renminbi feed into that narrative?
Yeah, I think it'll help because, let's face it, the noise is big in the markets today, and maybe there's not a lot of volatility in the financial markets themselves, but there's a lot of volatility in the news. And so I think that, in fact, if the renminbi is gradually appreciating, which it has been doing, it went up about 6% last year, and I think it's up about 1% so far this year. And to get back to where it's high of 2015, it could go up another 10%. That, I think, would be seen as some kind of sign that something is going right in China. Of course, we know from the economic data that it's all very soft there, with one exception, which is the exports. And I think they can afford to let the currency appreciate a little bit and not hurt the exports dramatically because they had a trade surplus last year of $1.2 trillion. But the big story in China, in my opinion, is that it's really emerging as a technology hub and powerhouse. And there's so many examples of this. It's just become very obvious that they are now making good quality products and services in high-end technology that has a market around the world. And that, I think, is the investable story in China.
I guess to your point, in this increased appetite for Chinese tech, at the time where there are questions swirling on the US side of things, perhaps today the moves we're seeing in NASDAQ futures, this steep, which is not typical this time of day, does that also speak to, I guess, the rethink when it comes to AI? Has it more to do with the flows that are going into China? And I wonder as well what your sense of the kind of spending that has gone into the industry. Is there a rethink there as well? Do we need to recalibrate our expectations on US tech?
Very much. In fact, we've been, should I say this, we're the least optimistic on US technology stocks, the Magnificent Seven, than we have been, I think, in easily a decade. We believe that there's a rotation occurring that's coming out of them into emerging markets. I just talked about China, but also hard assets like metals and other materials. And that is to the detriment of the big U.S. technology stocks. 10 years ago, 4 of the 10 largest stocks in the S&P were technology stocks. Now 8 of them are. And those 8 are also 8 of the 10 largest stocks in the world. There's only Saudi Aramco and Taiwan Semi that are in the top 10 stocks in the world. They're not U.S. tech stocks. So this is a major concentration risk for portfolios that are weighted according to benchmarks. And I think that during the course of this year, you will see continued rotation away from U.S. technology to, as I said, emerging markets and hard assets.
We actually had seen a lot of optimism about the Japanese economy and the Japanese markets as well, right? Given that we're headed into the election this weekend, how big are the implications of what might happen there to the markets, especially at a time when there's a lot of confusion about what the government wants in terms of the yen?
Yes. Well, I think all you have to do is look at the 10-year JGB yield. The government can't really stop that from doing what the market wants it to do, and it's telling us that interest rates are going to go up in Japan. I would think a natural corollary of that would be a stronger yen. I don't think that makes Japanese stocks unattractive the way that historically you had this inverse correlation between the Nikkei and the yen. But I would say that the way I approach Japan is to focus on companies, because as much as the government might want to stimulate the economy, let's face it, it's a very developed economy. They are old and they're getting older, and I don't think they can solve that problem that easily. So by all means, it's good to stimulate, but I don't see Japan returning to a high economic growth rate, and therefore what I'd rather focus on is among the 5,000 listed companies in Japan, so you've got lots to choose from, the companies with high returns on equity. And thankfully, there are many, many of those. You can easily construct a portfolio of companies with returns on equity of 20% or more, good quality global brand names. And that's what I do in Japan.
Mark Matthews, always great to get your insights, head of Asia research at Julius Baer, as we keep our eyes on Japanese financial institutions today, given that we had some earnings last week. And we're seeing some upside for Sumitomo Mitsui, for example, that topped estimates when it came to profit. They got that lift from higher interest rates here in Japan, with net income jumping 12%. A whole different story for Nomura, just because they got pressured, missing analyst estimates with a 10% slide in profit, blamed on losses in Europe, and also there was a one-time hit tied to a major acquisition. We have more ahead on the Asia trade. This is Bloomberg.
Iran Supreme Leader Ayatollah Ali Khamenei has warned of a regional war as tensions continue to mount over potential U.S. strikes. But President Trump says he's still hoping to reach a deal.
Say that, of course you can say that, but we have the biggest, most powerful ships in the world over there, very close, a couple of days, and hopefully we'll make a deal. If we don't make a deal, then we'll find out whether or not he was right.
Bloomberg editor Mike Keefe is following developments for us. Mike, what do you make of the tone from the U.S. president that they're still hoping for a deal?
Yeah, Avril, I mean, there's been a few events going on around this, and what we've been reporting as well, Bloomberg, is that there's actually some talks going on behind the scenes here as well. So I'm not sure if this sort of public tit for tat about regional wars and Iran being ready and President Trump saying that that they have this great armada and can execute strikes. It might just be a little bit of bluster there as well. I mean, you'd certainly hope so, but when you're at this stage where you do have a carrier strike group, you do have a lot of options there, and it does seem like a bit of bluster on the part of the Iranians. What we saw last year was that their military performance was far, far below what anyone had anticipated. Their ring of fire around Israel has been blunted somewhat, and they weren't really able to fight back against Israel or the US. So, their capacity to withstand a strike is certainly debatable. I mean, the broader question, though, is what the US sort of aims are there. I mean, to get a nuclear deal, what's sort of the point of strikes to do that? Perhaps you can target, again, nuclear facilities and that sort of thing, but it's quite difficult to actually be sure that you've got everything, you've managed to hit everything in this case, and Iran has the know-how to come back and do this again. So it's just unclear what the ultimate objective is. Now, we've had Israeli officials in Washington as well, and they're sort of inclining towards, if you're going to strike, maybe it's worth trying to get rid of the regime. It's a deeply unpopular regime. I mean, the Supreme Leader is an octogenarian. They don't have any real relationship with a young population, and as we saw, there were big protests there as well. 3,000 people officially killed there, and reports that it's probably double that number as well. So there's a lot going on. But if you were to overthrow an Iranian regime, we saw what happened in Iraq 20 years ago or so, that it can be a powder keg as well. So there's a lot to think about there.
We had heard from President Trump that the Iranian officials have reached out in order to have negotiations last month. So what do we know about potential discussions in the background?
Yeah, well, I mean, Shery, I guess the idea is that Trump's sort of back to this issue of no nuclear weapons. Now, last year when the US dropped those bunker-busting bombs, he sort of suggested that the whole thing was done and dusted, which a lot of experts said was probably not quite the case. And this seems to suggest that it's not as well. Now, the US in the past has had specific areas, and it wanted Iran to do things like also wind back its ballistic missile programs, which has been a red line for Iran. It won't do that. So again, I guess it's just a question of, does the Iranian regime think this is bluff, or that President Trump is prepared to go through with this? I mean, it's a fine judgment call. It's not like they can rely on their people to rally around them. I mean, traditionally countries do. I know, sort of gather around their leadership, but the divide between the regime and the population here is quite stark. So they really don't want to get into a tussle with the US, but then they don't want to give up that nuclear thing as well. So it's really, really hard to know. And obviously behind the scenes, no one's giving much away because they want to keep that big stick that they hold, particularly on the US side.
Economy editor Michael Heath there with the latest on geopolitical tensions around Iran, of course, which has moved the oil market already. We continue to see the downside pressure there. Take a look at broader commodities as well, especially in the metal space, as we're seeing gold continuing to extend those declines after that historic fall over a four-decade historic plunge that we saw. We hadn't seen such a magnitude of losses for gold prices that abrupt since the early 1980s. Especially after it topped already $5,500 an ounce. Also, silver, a little bit of upside, but this after a 26% dropping, the biggest on record. Also, Friday's crash seems to have come potentially also in part because of the U.S. dollar spike after a nomination of Kevin Warsh to lead the Federal Reserve. And we have seen also the gyrations in the copper space already last week. A lot of speculation in the metal space, especially by Chinese traders. But you can see right there on the right side, some of those miners in the Australian session already pointing to a lot of downside at the moment, Avril.
Shery, some of the top global headlines we're following as well. India's government has delivered an annual budget focused on supporting exporters battered by U.S. tariffs and boosting sectors such as rare earths, semiconductors and critical minerals. Finance Minister Nomura Sitharaman announced plans to cut taxes on equipment imported to process critical minerals. Now, in a bid to reduce dependence on China, the budget also includes support for mineral-rich states to set up dedicated rare earth corridors.
We now propose to support the mineral-rich states of Odisha, Kerala, Andhra Pradesh and Tamil Nadu to establish dedicated rare earth corridors to promote mining, processing, research and manufacturing.
UK Prime Minister Keir Starmer has vowed to deepen ties with Japan as he travelled to Tokyo following a visit to China. Starmer met on Saturday with his Japanese counterpart Sanae Takaichi, agreeing to work together on areas including security, industry and technology. They also pledged to strengthen the supply of critical minerals. The U.S. Justice Department has released about 3.5 million more pages from its Jeffrey Epstein investigations. The files show that some prominent figures, including Commerce Secretary Howard Lutnick, stayed in contact with Epstein longer than they had claimed. The released materials also include emails and messages exchanged between Epstein and top Goldman Sachs lawyer Kathy Rumler. We have more ahead on the Asia trade. This is Bloomberg.
Laser tech here in Japan under pressure, dropping as their full-year order forecast was seen as disappointing the market. Some of their customers include Intel, TSMC, and Samsung. Putting it into perspective, though, this stock has more than doubled in the past year, all to do with expectations of AI spending. Nvidia CEO Jensen Huang has shared more details about the firm's commitment to OpenAI. This comes after the Wall Street Journal reported that Nvidia's plan to invest up to $100 billion had stalled. Speaking in Taiwan, Huang told reporters the company would definitely participate in OpenAI's latest funding round.
Sam is closing the round, and we will absolutely be involved in
How much? Can you say how much? Can you say how much?
We will invest a great deal of money, probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
For more, let's bring in our Asia Tech correspondent Annabelle Drillers in Hong Kong. Annabelle, so this really gives us a significant insight into his spending plans. What else did he say?
Yeah, that's right. It wasn't exactly a walk back of this commitment, but it definitely was a clarification of sorts. And this is a really important nuance to share. But I think we have to start really by going through the context of what was signed back in September of last year, because this was a point where the two companies, OpenAI and Nvidia, signed a letter of intent, but essentially to form a strategic partnership. So this goes through the details of exactly what was signed. But looking at OpenAI essentially building and deploying at least 10 gigawatts of AI data centers, and these were going to be using Nvidia systems, and that was what was announced back in September. So in terms of what would actually be necessitated from that, of course, it means a commitment financially from Nvidia. And this is the concern here is that maybe Nvidia is starting to cool on the partnership. And we get more on that in just a moment. But the dollar figure of what was mooted at that time was up to $100 billion. And you heard in that soundbite there, Jensen Huang was asked about that. Would it be $100 billion in the next funding round? He definitely said they're taking it one step at a time. Yes, he believes in the company. Yes, he believes in the work that they're doing, but he's really emphasizing that up to at this point in time.
Tell us quickly as well about these reports of Jensen Huang being concerned about investing in OpenAI, Belle.
Yeah, so this was the big story from the Wall Street Journal on Friday, and essentially what they said is that Nvidia is maybe stalling on its commitment. There's concerns about maybe perhaps, and this is again according to their reporting, but the way that OpenAI is being run in particular. Jensen Huang also cooling on perhaps a lack of discipline in the business approach. So will Nvidia proceed with the size of this commitment, I think, is the big question. But what the Wall Street Journal is saying is that since that letter of intent was signed back in September, actually the talks from this point have stalled.
Well, thank you so much. Annabelle Drillers in Hong Kong with the latest. More ahead on the Asia trade. This is Bloomberg.
The Fed should focus on its job, which is financial stability and lower interest rates and low unemployment rate, low inflation, and it should try to basically do that the old-fashioned way, quietly. I think that there's time right now for the Fed to focus on, I mean, obviously it depends on what they do with interest rates, but for the Fed to focus on getting the balance sheet as lean as possible.
White House economic advisor Kevin Hassett there on the Fed's focus on financial stability and keeping its balance sheet lean. As we continue to watch the Asian markets today, a little bit of a mixed picture with big upside on the Nikkei and Japanese stocks gaining more than 1% there. Of course, we are seeing the weakness of the Japanese yen, especially after Prime Minister Takaichi's latest comments when it came to the weak yen being a potential opportunity for export industries. We're seeing the Kospi and the ASX 200, though, to the downside. The Kospi, after we saw some exports extending their growth streak, streak in the month of January. Of course, semiconductor gains have been huge, growth of 103% for the month of January, while the ASX 200 is under pressure, given the big commodity sell-off that we have seen in gold, silver, not to mention oil as well. PMIs right now coming in from Malaysia, from South Korea, from Taiwan as well at the highest levels since 2024. So we continue to see some improvement on those numbers in expansion territory above that 50 level. And when it comes to the Philippines as well, manufacturing PMI rising to a 9-month high. Japan's January manufacturing PMI also at around that 51.5 level. And really, as we continue to wait for the latest Avril when it comes to the private gauge PMI out of China as well.
Absolutely. We are also keeping tabs on India's economy after the government delivered a budget that sharpens Prime Minister Modi's strategy of shielding the economy from U.S. tariffs while maintaining fiscal restraint.
Fiscal deficit kam karne.
The budget focuses on reducing the fiscal deficit and inflation control. The budget also harmonizes high capital expenditure and high growth. This budget reinforces India's global role.
Let's bring in Bloomberg's Asia Pacific reporter Swati Pandey for more. So, Swati, what were your key takeaways from the budget?
Avril, this budget was meant to be a plan for India to shield its economy from U.S. tariffs, but also to put India in a position where it can deal with this new world order where there is a lot of global geopolitical uncertainty. So we saw an increase in plans for infrastructure spending, for manufacturing, especially sectors that are very export-oriented. Some of those sectors have taken a big hit after U.S. put those 50% tariffs on Indian goods. So these are textiles, leather goods, furniture. So they spoke about small and medium businesses that are heavily impacted. So some SOPs were given to them. Defense spending was increased by 18%, and that was largely because India faces these dual rivals in China and Pakistan. So that was expected, in line with expectations. There were some announcements around boosting India's semiconductor manufacturing, and there was also some SOPs for critical rare earth magnet in-house production with some eastern and southern states which are mineral rich, getting some money for creating those critical mineral corridors.
Yeah, a lot really in strategic sectors that could be geopolitically significant as well, right? But Swati, tell us a little bit about the market moves in the Indian market since we're headed towards that open as well, given that we saw big gyrations around some government moves in order to curb speculative trading.
Yes, so the stock market was open yesterday on Sunday, and it looked like the market did not take the budget very well, but that was largely because of the tax on equities derivatives trading. Although the budget was seen as a bit lackluster in terms of boosting economic growth and employment in the country, the big reason for the decline in the stock market was that equities trading tax, and the government spending plan, the borrowing plan, was also higher than expected. So that is likely to put some pressure in bond trading as well.
Swati Pandey, good to have you with us. Bloomberg's Asia Pacific economy reporter with the latest on India. As we also saw those metal stocks across India move, gold especially moved in that market. We'll be watching those related stocks at the open. But you can see gold futures now recovering a little bit, up 2%, together with silver gaining 11%. And this, of course, after that meltdown that we saw last week, gold seeing its biggest sell-off in 4 decades, and silver at one point plunging by $40 an ounce announced in less than 20 hours. Really part of that trigger coming from the dollar spike that we saw given the news around President Trump's nominee of Fed chair. But let's get more market perspective and bring our next guest, Daniel Hynes. He's the senior commodity strategist at ANZ. Daniel, great to have you with us. What's happening in the metal space? Because last week we're also contending with gyrations in the copper market.
Yeah, I mean it's really hard to get or put a finger on, I suppose, what ultimately caused this volatility. But certainly there was some pretty frenzied trading. I mean, certainly the aspect around the Fed's independence. Was been or has been a real driving force over the past few weeks, and obviously the announcement that by Trump of the new potential new Fed chair did obviously represent a little bit of a downside to that risk, I suppose, and that triggered a rebound in the dollar, which was impetus for a pretty harsh sell-off, but. I think the fundamentals remain still pretty well in place, despite those easing risks around Fed independence. It's more broad than that, and it's obviously the geopolitical tensions which are still emanating quite strongly across the markets. The general upending, I suppose, of that world order that we hear about constantly, and the US's role within that, has been really at the crux, I suppose, of this haven buying, and I don't see that ending anytime soon. So while this volatility is going to remain relatively high, I do think the underlying drivers should still provide some upside support for the precious metal sector.
Especially for the likes of other base metals as well, like copper, for example, and their role in this transition that we're seeing and the huge investments into artificial intelligence and continued green transition as well.
Yeah, no, absolutely. And I think the dynamic between the two is quite interesting. I look at, the copper gold ratio as a bit of a indicator for, the global economy. And that has actually been trending lower. Which suggests, that the backdrop is potentially weakening. But I think the dynamics around both copper and gold are quite different. And look, can go in competing or differing sort of directions depending on their own sort of dynamics. And I don't think it suggests, that the economic backdrop is weak. I just think that. The market is still trying to work out the allocation between, or the capital allocation between that geopolitical sort of driven investment demand coming through in gold and clearly the strength in the copper demand coming through at the moment. I do think that, the underlying underpinnings of copper are still very strong, and we would expect to see that continue to rise as well.
How even is that demand and that underpinning when you look across the Asia region? I mean, we just got China's factory activity unexpectedly contracting. So what are you seeing in terms of the fundamentals that are driving the demand side of the equation for industrial metals?
Yeah, I think the dynamics around demand are clearly shifting at the moment. It's been in the past, obviously, a proxy for that broader economic sort of activity, but it's become a little bit more nuanced to that in recent times. And we are seeing copper demand run at higher growth rates than what sort of GDP sort of level growth would suggest in a lot of economies, including China. And that's driven not only by the energy transition and the IA sort of triggered investment we're seeing. It's specific to, I suppose, the electrification of the world economy and what that brings. And I think a lot of countries have been a bit lax around building their economies to withstand this type of transition. And there's certainly a little bit of catch up required as a consequence of that. And so that's why I expect to see, these growth rates in demand continue to push higher, despite, some issues around Chinese growth in the near term.
Daniel, also, what sort of assumptions are you making about the dollar for this year, as we've seen it, the soft dollar dynamic, playing out in the propelling of commodity prices? Is that the same assumption you're going to have for the rest of the year?
Yeah, I mean, our house view is that we'll see further declines in the dollar over the course of 2026, but it's not going to be, a sharp correction. I think more of a gradual sort of easing. And, that has been obviously supportive for commodity markets in the past, although I would suggest that, even with, a US dollar holding relatively flat, we can still see gains across most of the commodity sectors during the course of the next 12 months. And that's because of those issues we've just been talking about. But, clearly it's going to help. If we do see, further weakness, then it's more likely to induce a little bit more investor appetite for the sector.
And what about for oil? Because, of course, we do have the geopolitical tensions around Iran, but at the same time, we've been talking about oversupply in the market for the longest time.
Yeah, and I think that's, a key point. It's probably one of the most publicised, gluts of oil that we've seen in some time. And I think the market has priced in that outcome relatively well. So for me now, I think the risks are probably more skewed to the upside, and that's coming through that supply channel. Clearly, the geopolitical tensions in the Middle East and even in Latin America are obviously providing some support at the moment. But, when you look at OPEC, they've obviously paused their production hikes for the first quarter this year. But we have seen, performance of those hikes previous to this pause, come up a little bit short. And I do feel like there's a little bit of, or the upside, I suppose, to further gains in OPEC supply are actually a little bit more limited than maybe the market is assuming. So the supply outlook is definitely shifting at the moment, and I think that will result in potentially a more tighter market than we had previously expected. And I think the market is coming around to that view, and why we've seen sort of prices, stabilise and push a little higher in recent weeks.
Daniel Hynes, always a pleasure chatting with you, Senior Commodity Strategist at ANZ. We have more ahead on the Asia trade. This is Bloomberg.
Apart from the Space Summit, the Changi Aviation Summit also underway here in Singapore, along with the Singapore Air Show. Let's bring in our next guest, who runs the largest low-cost carrier in the Philippines, which operates flights to more than 60 destinations across 14 countries. Joining me now is Mike Such, CEO at Cebu Pacific. Great to see you again.
Great to see you again, Avril. Thanks
so
for
I just
having me.
wanted quickly your thoughts on how the year has been going so far, particularly as it pertains to supply issues. What is your best case, worst case scenario for both growth and capacity?
Well, we came off a very good year last year. We ended the year strongly. December was our busiest month ever. 2.7 million passengers took us to 27 million passengers for the year. So we grew by 10% through the last year. And we're carrying that now into this year as well. I anticipate growth this year to be of the order of, 10, maybe a little bit higher percent as we go through. Obviously, we're managing all the issues on supply chain, monitoring the engine situation. But we've got a better handle on that now, I think, than we've had. We've had a few years doing this, managing the situation. And I think people like Pratt & Whitney are now starting to get a handle on it as well. There's signs that things are improving. So I'm confident of the sort of 10% guidance that we're giving forward for the year ahead.
So do you think you'll still be dealing with these Pratt & Whitney issues in the second half of the year? I mean, in what shape and form by then?
I think we've got another couple of years to run, but we're going to start seeing things improving in terms of the number of AOGs that airlines have. We had about, at times, 16 aircraft on the ground last year. We're currently at 8, and we expect it to sort of maybe stay at that level for a few more months and maybe come down then towards the end of this year. And then next year, again, it will start to come down. By 2028, I think we'll start to see the end of it.
Okay, you are also taking in new aircraft at this time, aircraft that have a record number of seats. I wonder how is that playing into helping you with costs?
Well, no, it's absolutely, it's wonderful, the cost. It's also good from a sustainability point of view, the environmental footprint that each passenger makes when you put more seats on the aircraft. And, I mean, we led the way in this with our 330s. We've got 459 seats. We work with Airbus on that. That aircraft has the lowest unit seat cost of any aircraft out there, period, and indeed the lowest environmental footprint per passenger. Now, we've taken that thinking onto the A320s. The A320s, we now have a 194-seat A320. But which is only 6 seats more than others. But what we've done is we've very clever engineering from Airbus. They've moved the galley. They've moved the galley from a lateral position to a longitudinal position, which generates the extra 6 seats. And the comfort level for the passengers is exactly the same. And all we've lost is 1 trolley. But what we've gained is 6 seats, and it lowers our seat cost by 3%. Now, in an environment where cost means everything to the passengers, that 3% is significant. So we're very pleased with this aircraft, and it's been well received already whilst it's flying.
Cost means everything to the passengers. It's coming after a year where low oil prices have helped the industry. Do you expect that to continue this year, given all the geopolitical developments?
Well, I think the natural trend for the moment is oil to come down. The only thing that's going to keep it up and cause it to spike, as we saw last week, is on the geopolitical front. But the long term, I think for the next year or so, is that oil is going to soften. And of course, that is good for everyone in the industry. And certainly that's going to help us through this year if oil prices continue to trend down. But we do need to monitor for, as you say, those geopolitical issues that crop up ever more regularly.
To what extent are you also perhaps factoring the costs from the weakness of the Philippine peso? Because we know how most of your costs are denominated in the dollar, the greenback. So what is that meaning for your cost?
About 2/3 of our cost is dollar based, and so the shift on the peso does cause us some concern. But of course we offset that through all the other mitigation measures we do on cost. You know, the seat cost change due to the extra seats on the A320 as an example. But overall, we're seeing with the fuel coming down as well, the net effect so far is that we expect costs this year on a unit basis to come down.
And to what extent are you going to be able then to pass on these cost savings to your passengers?
Well, as I say, this year I'm expecting our unit costs to come down from where they were last year overall. I think it's a combination. Yeah, fuel is a positive for us. It's a good variance for us, whereas obviously the FX is slightly against us. But we are getting more efficient. We are getting more efficient in terms of utilising our assets. We're having fewer aircraft parked on the ground. So our asset utilisation is up, and that translates into lower costs as well.
Okay, we're going to have to leave it there, Mark. Thank you so much for coming and sharing your plans for the business with us, and all the best, because this is, of course, a year where you guys are celebrating your 30th anniversary as well. Great to have you with us. Mike Such is CEO at Cebu Pacific. We have much more ahead from Singapore as we focus on the aviation and space sectors. Here at the Space Summit, we'll be joined by China's Galaxy Space, Indian satellite startup Pixel, and Agnicool Cosmos, the company behind the world's first 3D printed rocket engine. More ahead on the Asia Trade. This is Bloomberg.
We're in the thick of earnings season, especially for financial institutions here in Japan. And you can see a little bit of divergence right there with most banks gaining ground at the moment. But you're seeing Nomura under pressure after their profits missed estimates. Let's actually get more on the earnings season for these lenders with Asia Investing and Finance editor Russell Ward. Russell, so should we start with the likes of Nomura, Sumitomo Mitsui, especially Nomura, given that they surprised to the downside?
Yeah, that's right. Nomura was a bit of a negative surprise. The profit was due to expected to fall just a little bit, but they ended up falling a little bit more, 10%, and that was mainly due to some one-time costs tied to its acquisition of Macquarie's asset management business earlier in the last year, but also it was tied to some losses in its crypto business in Europe. So that's a little bit of a negative surprise. Sort of came out of nowhere a little bit. So maybe investors are a little bit nervous about that one because of course this also came against the backdrop of a buyback. So Nomura was announcing a buyback, had otherwise solid results, but these two incidents sort of marred the results somewhat.
Yeah, because solid results, the environment seems to be broadly good for these banks, especially Sumitomo Mitsui, for example.
That's right. So Sumitomo Mitsui's results were very good, better than expected. As expected, the bank is really benefiting from the BOJ's rate hikes at this point. Lending income rose, loan demand still remains high. So that was very good. It also generated a lot of income from its fee businesses as well. So it's very positive results from Sumitomo Mitsui, and we're probably expecting more of the same when the other banks report.
Mizuho, Daiwa today, MUFG on Wednesday.
That's right. So Mizuho is reporting this afternoon, MUFG on Wednesday. Both of them same drivers as Sumitomo Mitsui, on track for record profits this year. At the moment, the BOJ's rate hikes are a tailwind. The markets are positive. But, of course, there are uncertainties down the road as well. Daiwa, we'll have to see whether they slipped up in the way that Nomura did, or whether they are also, benefiting from the positive market environment, the deal-making boom that is, helping Japanese brokerages too.
Asia Investing and Finance editor Russell Ward here with the latest on these Japanese lenders and the earnings season underway here as we continue to watch the Japanese equity space. Broad upside that we're seeing here, and take a look at how futures are also trading, because Hang Seng futures, TAIEX futures also to the downside. A lot of downside pressure given that we saw the U.S. stock sell-off, not to mention the precious metal sell-off, the dollar spike as well. That's it from the Asia trade. Our markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen. The China show is next. This is Bloomberg.